Hello and welcome back to the Volunteer Income Tax Training Series. My name is Chris Moon. I am an Associate Teaching Professor at Iowa State University in the Ivy College of Business. And in this video, we are going to be talking about the standard deduction and the tax computation. So this standard deduction is what it is, so it probably will not take us very long, but there are a few things that we need to talk about. So we will determine the standard deduction for most taxpayers and also the standard deduction for taxpayers who are claimed as dependents. There's also special calculation for taxpayers who are over 65 or blind, and so the standard deduction is higher depending on those factors. So we'll talk through those. All right, so before you even start the return, it is really important to just, again, take a look at the intake form. I know I keep saying that, but looking at what deductions the client may have, if they have mortgage interest, if they have real estate taxes, and seeing if those items are going to be in excess of whatever their standard deduction would be. This chart right here is from 2024. I can tell you right now that it is not correct. I'll amend it for you right now. If you look at page F3 of your 4012, this information is correct. If someone is single or married filing a separate return, the standard deduction is $15,000 this year. Married filing a joint return or qualifying surviving spouse with dependent child, it is $30,000 this year. And if they are head of household, it is $22,500 this year. So TaxSlayer will automatically put those numbers in, but I don't want you to think that these numbers on this slide are correct because the IRS did not get that updated. So taxpayers who cannot take the standard deduction and must itemize are as follows. If you are married, filing separately, and your spouse itemizes, you have to itemize. They do that so that you can't say, like let's say you have itemized deductions that total $17,000, right? So if one spouse could itemize and take that $17,000 in itemized deduction, and the other spouse takes standard deduction of $15,000, then you're way ahead, or a little ahead at least, of the standard deduction of $30,000 for married filing jointly. So in order to avoid that happening, they prohibit you from having one spouse itemize, one spouse take standard. So if you do married filing separately, you either both itemize your separate returns or you both take standard on your separate returns. Also, non-resident aliens must itemize their deductions. When I do the video for the 1040 NR returns, we'll talk a little bit more about that, but they do not, unless they're from India, they do not get a standard deduction. So when you put the information into TaxSlayer, it's automatically going to give them the standard deduction that they're entitled to based on their filing status, their age, and whether or not you've indicated that they are blind. So it will calculate based on those factors. So it is important that you, as part of the intake procedure before you start the return, that you go through all of that stuff with a client and make sure that you've got the correct information. All right, so the standard deduction for taxpayers who are, or spouse who are 65 or older, or if one or both spouses are blind, are a little bit more. Again, the IRS did not get this chart updated. This is from 2024. So just as an example, I will give you, if you are married filing jointly and one of the boxes is checked, then your standard deduction is $31,600. This chart shows it as $29,200. That was from last year. If you look at page F4 of your 4012, that will give you the correct amounts. That chart is on there. But again, when you mark all of the information in TaxSlayer, it's going to automatically calculate it for you. It's just, we talk about it here so that if you didn't know why someone was getting a higher standard deduction, this explains it to you so that you have the ability to explain it to the client. All right, if a taxpayer can be claimed as a dependent, then they generally have a lower standard deduction. TaxSlayer is going to go ahead and calculate that for you once you click that the person can be claimed as a dependent, but the standard deduction for people claimed as a dependent is going to be up to their the income they earned or the regular standard. It won't be above the regular standard deduction, but again, TaxSlayer will calculate that for them. So if you have a 16-year-old who worked and made $8,000, their standard deduction is going to show up as $8,000, or depending on if they had other income, or it'll show up as that. All right. Sometimes it is going to make sense to itemize deductions, and because the standard deductions have been increased so high, most of our clients with income below $67,000 or $70,000 don't have enough out-of-pocket expenses to justify it. There are situations, though, where people maybe have assets but not a lot of income coming in, and they have sufficient, so they qualify for VITA, and they have sufficient expenses to justify itemizing. So if they have huge out-of-pocket medical and dental expenses, if they have a lot of state and local income taxes and real estate taxes, high mortgage interest, a lot of gifts to charity, then they may qualify to itemize. But it does always make sense to do a quick add up of those numbers before you even start the return, because if it doesn't amount to the standard deduction or close, we shouldn't be taking the time to enter those because it's not necessary. All right, if you have if you're doing a return for a child under the age of 18 and they have unearned income over a certain amount, they may be taxed at higher rates. And so this is pretty uncommon to see, but if you do end up having someone come in to get their taxes done that has a lot of unearned income, it's more than the ceiling amount, and they're required to file a tax return, then you do have to file that Form 8615 if all of these things listed here are true. I'm not going to read them to you, but if you run into a situation where a child has a lot of unearned income, then you may have to go through this process. TaxSlayer will walk you through this, but just make sure that you are completing that Form 8615 if they have sufficient unearned income for that. All right, so this is the last year for the QBI deduction, unless it got it may have gotten extended with the One Big Beautiful Bill, and I cannot remember that off the top of my head. But from the Tax Cuts and Jobs Act, the QBI deduction was through January 1 of 2026, so 25 will be the last tax year. So a sole proprietor would be able to take a deduction of up to 20% of their qualified business income. So the calculations on Schedule C and SC are not affected by this, but it is a deduction that is permitted on the 1040. Just as an interesting side note, the QBI deduction is after the adjustments and before the standard deduction or itemized deduction. So it is an additional deduction from those two. Once you enter the self-employment income in TaxSlayer, TaxSlayer is going to go ahead and calculate the QBI for you. So again, it's going to show up on the 1040. You just need to be able to explain to the taxpayer what that deduction is in addition to the adjustments and the standard deduction. It's 20% of their qualified business income. And unless this got extended, this will be the last year for that. All right, so in order to calculate the taxable income and the tax, you take the adjusted gross income that we had calculated before, you subtract out either standard or itemized deductions, and then you also take out the QBI deduction that I just talked about. And then the tax is calculated based on that base amount. So taxable income is your base. It gets taken times whatever rate you are in. There is a separate tax calculation for foreign earned income, qualifying dividends, and capital gains. Those are taxed at different rates. All right, so we talked about standard deduction. Just make sure, again, that you're paying attention to the factors that will allow a taxpayer to have a little higher standard deduction, knowing that that QBI is in addition to the adjustments in the standard deduction, and the tax computation is based on taxable income, knowing that some of that income might be taxed at different rates, and TaxSlayer is going to calculate that for you. All right, thank you.